Nadia, when it comes to the oil market, there are no immediate outages at this moment, but the risk calculus has certainly changed. How has it changed for you overnight?
So when we look at exports from Iran right now, they've been around 1.7 million barrels per day. This is very much in question. Will that continue? What will be the focus? And when we think about where the market has been positioned, we've had three surges of more than 400,000 barrels per day in expected production out of the Middle East, but we have not seen a single barrel flow higher out of the Middle East. So we've gone from a situation of enormous spare capacity expectations to actually seeing no additional oil thus far, and now even looking at the first potential loss coming out of Iranian flows.
Well, Iran accounts for about 5% of global oil output, but the Strait of Hormuz, Nadia, it is the choke point, nearly a fifth of seaborne crude. What is the risk that there's disruption there?
So the market has not priced in that risk thus far, in our view. When we look at the Red Sea, we had the Houthis with comparatively very unsophisticated weaponry shut that down for more than a year. And the expectations have been that, well, things will normalize, and we haven't even seen that normalcy. When it comes to Iran, if they were to strike a single oil tanker, it would completely change the industry in terms of flows. We've seen since COVID, it's very difficult to get personnel to feel safe to flow. So we would need military escorts, and it would take time to resume things. So it would be quite a shock to the market.
Nadia, to that point, we're not pricing that in. What would it look like to price that in? And should the market be doing it at this moment?
Yeah, so we've had short positioning in the market. And what we saw just in this last week is some of the fast-moving algorithmic traders, they started to get a signal to buy. But when we look at these long, slow-moving algorithms, above $72 Brent, where we are right now, they start to get a signal that they shouldn't be short. If they were to decide, and we stay up here above these levels, it would take about 2 weeks for them to change those short positions into long positions. That means that we can have quite a lot of price appreciation just based on price momentum before we start looking at the actual fundamentals. The oil market is tight. We have low inventories going into peak demand season. And this is where we've had equity research forecasting, $56 to $61 Brent as their base case in the second half of the year because of potential trade wars and things like that since Liberation Day. But we've been trading at above 60 since OPEC has announced two boosts of 800,000 barrels per day of oil. And that is simply because the market is very tight. So we see continued upward momentum from where we are.
Is that triple digits, Nadia? Just how much upward momentum?
Well, that is very difficult to say. I mean, the main difference now versus the last time when Israel and Iran had their strikes on each other is both parties immediately stated, we're done. This is what we wanted to show. What Benjamin Netanyahu has expressed now, we need to be involved here for as long as it takes to ensure that Iran does not have nuclear capabilities. That, as a result, escalates the situation, and it also increases the likelihood of potential mistakes that escalate things further, as in an accidental oil tanker being hit, for example. And that's where it's very difficult to say. We have to take one step at a time. Right now, all oil is still flowing, but that can change very quickly.
Nadia, in the scenario where there's escalation, in the scenario where the Strait of Hormuz, specifically LNG, is hit, we were talking about this during the commercial break, that could really hamstring Asia's capabilities to get their hands on LNG. How does that change the dynamic between what we're seeing in negotiations between the U.S. and China?
Yeah, so what Trump really wants to do is fix the trade deficit with China. What does the U.S. export? Oil, LNG, and LPG. Those are enormous trade routes. When you look at Qatar, they're one of the three largest LNG exporters. That is a big difference and an opportunity for the U.S. to get these long-term agreements going with China to fix that trade deficit long-term. LPG, 8% of the world's LPG flows out of the Middle East just to China, right? Or 8% of Chinese imports. right now, we do not have an exemption for LPG exports out of the US. They've only included, the Chinese, an exemption for ethane. The entire petrochemical market growth story is very dependent on LPG coming out of the US. So this is the part of the negotiations that could really help the Trump administration. And it's when Asia actually and China really needs America. So we expect shipping stocks, crude carriers, LPG carriers, LNG carriers, all of that to start to see some of this upside in their pricing as the market realizes that these are the diversions that are necessary. It's much further to sail from the US than it is to sail from the Middle East to China.
Just to be clear, Nadia, will this happen regardless of where we move from here, or is this the scenario where you do see LNG taken offline?
Well, we expect that it's all about energy security. We've been talking about this in Europe ever since Russia invaded Ukraine. And now we see this is absolutely necessary on a global scale. And every country wants to increase and diversify where they get their flows from. So that includes the US. It includes Argentina and growth in shale production. This is where that change into inefficient shipping routes, that is absolutely what everyone has to do and secure those volumes. And that's what oil traders, LNG traders, and LPG traders are going to be doing today with their bookings.